Next speaker is Jordan Brooks from AQR Capital Management, who will share with us his, and I assume AQR's, views on the macroeconomic environment and the future. Jordan, the stage is yours.
Well, thank you very much, and thanks to the organizers. This has been a great day. Lots of lively discussion, so really been enjoying it so far. So I'm going to spend the next half hour or so, and I plan to leave time for discussion, discussing the macroeconomic backdrop. We're going to spend a bunch of time on that. But I would like to conclude by discussing what this means for investor portfolios, not in any great depth, but some implications both for strategic asset allocations as well as for portfolios more broadly. The dominant theme that I'm going to touch on is we could have disagreements about directions that markets are going, directions that the economy is going, but we're certainly in an environment of high uncertainty. And that's something that's going to be important for market participants to recognize and to make sure that portfolios are designed, robust to those type of macroeconomic perturbations that we're likely to see. Like any good backdrop, like any good discussion of where we're going, it's very important to retrace our steps, start from what we've seen thus far. So over the past 12 to 18 months, right, we've seen a large and meaningful inflationary shock. You think about where we were, call it 18 months ago, right? The perception was we started seeing inflation tick up. Perception was that it was largely transitory due to supply chain disruptions. And you see on your chart up there, you see inflation expectations. These are revisions in inflation expectations, month-on-month revisions. And you see that they start ticking up throughout the spring into the summer of 21. Again, we had that perception that inflation was transitory. The way I think about this is that there are two sins here. One is forgivable and one is not. The forgivable sin is that inflation was transitory because supply chain issues and supply chain disruptions were likely to be transitory. Of course, that turned out not to be the case. Supply chain disruptions were a lot more persistent than we had originally thought. The second sin, one which is a little less forgivable, is I do think in our blissful ignorance, markets, economists, central bankers all suspended a little bit of their Econ 101 knowledge. Everybody forgot temporarily that the stubborn thing about inflation is it doesn't necessarily matter whether the catalyst is persistent or transitory. Even transitory catalysts could introduce persistent adjustments in inflation as higher prices get built into price and wage decisions. But what we've seen, again, is inflation and inflation expectations creep higher. One thing I want to point to is how persistent this phenomenon has been. That top left chart, as I said, is cumulating revisions in inflation forecasts. If I cumulate revisions, I'd expect them to go up and down, right? My revision this month to last month should be unrelated to my revision last month to the previous month. Yet market participants revised up their inflation outlook in the US, for example, 19 months in a row between January of 2021 and August of 2022. You do see a little bit of flattening in the US, not so much in Europe. That's quite interesting. I'm going to talk about portfolios. I'll mention this trend following strategies. This is one of the reasons trend following strategies have minted money. Markets have been persistently surprised. Economists have been persistently surprised. But for now, let's focus on the macro aspect. Large inflationary shock, persistent upward revisions, right? Becomes clear around this time last year that the transitory hypothesis is a fallacy. Central banks catch some flack. They're late to the game. But how late were they? Maybe a few months. At the end of the day, that's forgivable, right? But we see starting in late December, we see two-year yields start picking up. we see central banks start alluding to materially tighter monetary policy going forward. And since then, we've seen what I can only describe as a massive repricing of monetary policy expectations, especially coming off a 12-year period of exceptionally low interest rates. That tightening monetary policy has led to an economic growth outlook that's deteriorated materially. That bottom left chart, just real GDP forecast revisions accumulated. Same idea as the top graph, really coinciding with when central banks have tacked into a more contractionary stance. You see an economic outlook that, at least in expectation, has deteriorated. And in expectation is an important qualifier there. We have not seen this play out in broader economic numbers, particularly in the US, where the labor market remains incredibly resilient. The graph everybody's paying attention to, it came from that Ball paper, the number of unemployed workers per vacancy, really at all-time lows, an extremely tight labor market and a resilient economy. That's where we are, right? That brings us basically to where we are today. Now, how did assets respond to this? Well, the asset market response has been pretty much in line with what one would anticipate for a large inflationary shock and an associated repricing of monetary policy expectations. Stocks are down. Bonds have crashed. I choose those adjectives very specifically. Just to make that point, in the bottom graph, instead of just showing you year-to-date returns, I'm dividing by the historical standard deviation of those returns. Equities are down. It's about a 1 standard deviation event. It's painful for our portfolios. Bonds have crashed. This is the largest bond market decline we've seen in several decades. You have to go back to 1994. It's at that, call it, 4 standard deviation or above event. Stocks are down. Bonds have crashed. Linkers have outperformed nominal bonds. There tends to be a misconception among some investors that in an inflationary environment, linkers should be neutral. Linkers should be flat or perhaps even up. No. Higher inflation, associated tightening of monetary policy means higher real interest rates, higher real yields, right? That's a capital depreciation for inflation-linked bonds. But they should certainly outperform nominals. Indeed, they have. A great and different discussion we don't have time for is, have they outperformed nominals by enough? Short answer is no. Why? Well, why are break-evens 2.3%? Same question, same answer. Linkers have outperformed nominals. Credit has outperformed equities, right? You see on a risk-adjusted basis, yes, high-yield credit's down, but down very small on a risk-adjusted basis. High-yield credit in a monetary policy shock tends to hold up pretty well. Issuance goes down. Credit is fairly resilient. The dollar and commodity markets have been up, right? And I would posit this is exactly what one would expect. If you went to sleep this time last year, you had too much to eat, too much to drink at holiday dinner. You wake up a year later after a nice quiet sleep, and you say, somebody explains to you, shows you the graphs I showed you on the previous slide, and asks you to pinpoint what markets have done. I think you can get the order correct, right? So we're seeing a typical response, or the response we would expect to a large inflationary shock. But that's no solace for investors. Investor portfolios tend to be dominated by equity risk and nominal interest rate risk. No relief here for investor portfolios. That's where we are. Stock and bond portfolios are taking it on the chin. Let's spend some time on where we're headed. Showing you Euro-dollar futures curve, Fed funds futures curves, on a variety of different dates here. Let's look at November 11th. That was around the time I made the presentation. That was also around the time that we saw for the first time in months in the US, some good inflationary numbers. And the main point that I would like to make is, what have we seen over this time period? We've seen interest rates go up. Federal Reserve has moved up the front end of the curve, and expectations are for continued interest rate hikes. Right? So that's what we're looking at. We're looking at a period of continuing interest rate hikes. Now, you do see these curves all peaking, and peaking sometime next year. Markets have tested the resolve of central banks quite a bit. I count at least 4 times over the course of the year, none bigger than this summer. You see from the beginning of the year, 3 in January to 16 June, Federal Reserve raised rates. That's the front end of the curve shifting up. But expected future interest rates rose as well. Why do I choose 16 June? Well, that's the date where there was a big inflation number that came out, well higher than expected in the US. And that inflation number, and one of the bizarre market responses that we've seen, at least in my career, prompted a almost 2-month-long equity rally, one of the very few equity rallies that you could pinpoint the minute it started and the minute it ended. Right? It started on a higher than expected inflation print, and it ended when Powell took the stage at Jackson Hole. During that period of time, market logic was inflation is greater than we expected, therefore monetary policy is going to have to be tighter than we expected over the near term. Therefore, the economic contraction is going to be worse than we expected, and Lord knows central banks are not going to let the economy go into a recession, so they're going to be cutting interest rates very soon. If it sounds circular, somewhat irrational, it looks like a duck and talks like a duck. What is it? It's the market pricing in the good old Fed put. Right? And I think we see that over and over again. I won't run through all the different scenarios, but you could see it again, right, after that good inflation number that we saw earlier this month. There's been fits and starts in monetary policy expectations. And of course, as Patrick alluded to, communication about future policy every bit as important as the interest rate setting. Markets have continuously questioned the resolution of central banks, continuously questioned the resolution of the Federal Reserve. Each time the Federal Reserve has responded with vigor, right, and said, hey, recession be damned, getting inflation down to an acceptable level is our priority. We're seeing this again right now. We're likely to see that in the very near future with the Federal Reserve after what seemed like a message that Powell did not want to convey in his most recent speech. But to the point, central banks are resolute in their determination to kill inflation. It's certainly of my opinion that they will not be fazed by a recession, and higher for longer is something that I think we're going to become accustomed to. You're not going to get rates peaking in April and being cut in June. That seems highly unlikely. How does this play out? I have no novelty that I'm going to give you here on how monetary policy works. I like just opening up my freshman econ textbook. Monetary policy, tighter monetary policy, higher nominal interest rates, higher nominal interest rates, higher real interest rates, higher real interest rates, more saving, less spending. Growth contracts, right? Less jobs, less spending. Eventually that works its way into the real economy. So we're in for tighter monetary policy. This is what central banks are banking on to combat inflation, especially in the US, where every number seems to say that ingrained inflation is running somewhere like 5%, right? That's where wage growth is. That's where many of the core numbers are. But let's be a little more, even being a little more general in this statement. Right? The way the monetary transmission mechanism works is central banks like to stabilize growth and inflation, employment inflation. They like to stabilize employment at a high level. They like to stabilize inflation at roughly 2%. Right now, we see that inflation is destabilized. Inflation is highly variable. What's the objective of monetary policy? Reduce the variability of inflation, but that comes at increased growth variability. Growth risk is elevated. The growth outlook has yet to take a hit, or economic growth is yet to take a material hit, especially in the US, but that certainly seems to be something that's on the horizon. Forecasters seem to recognize this, so economists seem attuned to the monetary transmission mechanism. They see a high likelihood of a recession in the US and Eurozone over the next year. The more general point that I want to make is regardless about direction, recession or not, right, the speed at which disinflation takes place, abstracting from direction, uncertainty is at extremely elevated levels. This is a composite measure, that dark black line, of growth and inflation uncertainty, of volatility in growth and inflation. And you see that it's at a multi-decade high. And uncertainty tends to be persistent over time. High uncertainty tends to beget higher uncertainty into the future. And this is supported by a fundamental backdrop. So let's retrace our steps quickly before we move forward. Right? Do we expect a smooth and swift disinflation? It's possible. Pretty good scenario, though. Right? You never want your baseline to be the most optimistic outlook possible. Is monetary policy going to have no missteps along the way? Again, possible, but even legends, Hall of Famers in the annals of monetary policy, somebody like Paul Volcker, they're double-dip recession, right? There are often missteps. The likelihood of a smooth and swift disinflation is not something that I would say should be a baseline scenario priced into every market. Even if that's the case, it comes at the cost of monetary policy weighing down growth. So even if we see a smooth and swift disinflation, it's coming at lower inflation volatility, begetting higher growth variability. Uncertainty seems like it's here to stay. Over the longer term, 2010s were a very quiet decade from a macroeconomic variability perspective. The shocks we saw in retrospect weren't all that major. Sure, at the time, the taper tantrum, the sovereign debt crisis seemed like large macroeconomic shocks. But when you bookend that decade with the global financial crisis on the one hand and COVID, current inflation down on the other hand, you do see that we were fortunate in terms of the macroeconomic shocks that buffeted the economy. You had a period of relatively low growth, relatively anemic growth, and inflation that was stubbornly below 2% in the 2010s. Right? You had a mix of shocks that were tilted very much towards demand shocks in major markets, which meant central banks didn't face trade-offs between their growth and inflation mandate. All this together, and accompanied by, as Patrick spoke to, our star that was exceptionally low, meant that central banks could throw an abundance of stimulus anytime there was an adverse macroeconomic shock, which often meant an adverse market shock. All this added up to a low volatility environment in the 2010s. Unlikely we see a repeat of the same thing in the 2020s. More uncertainty seems like a pretty reasonable bet. Now, before we turn to portfolios, to what extent are markets pricing this in? I think that's a really important question. We've analyzed the backdrop. Are markets reflecting that? I'm showing you here break-even inflation curves. Break-even see a swift and steady disinflation. Right? They peak maybe at 2 years at roughly 3%, but you see a return to relatively low inflation rates very rapidly and very little risk of high inflation. Markets are pricing a resolution to inflation on a very, very short time scale, a time scale that we have not tended to see these things play out on before, a time scale that's not commensurate with even survey-based expectations, which are themselves not overly pessimistic. Survey-based expectations do see a return roughly to inflation target over the next 5-year period. We'll tighten it up. This is the perils of running perpetually late during the course of the day. I don't need to go into the more of the drivers of inflation, but let's stick with markets for a second. If we look at inflation, inflation seems to be priced by markets that will have a smooth and swift disinflation. Nominal bond yields tend to be somewhat fairly priced. So this is just looking at an expectations hypothesis-based model in each country, where bond yields compared to where expected policy rates are over the next 10 years. I'm looking at 10-year yields across the board, and you see bond yields that seem to be somewhat commensurate with expected future short-term interest rates. Right? Hard to argue that bond markets haven't incorporated some of this. We saw how large the bond market response has been. Bond markets seemed attuned to the macroeconomic backdrop. Where things get shakier is when you look at equities, right? So from a valuation perspective, equity valuations remain extremely rich. In fact, richer than the peaks before most drawdowns, let alone richer than the troughs of most drawdowns. And in terms of investor expectations of fundamentals, while the earnings outlook has flattened, these are earnings forecasts on the bottom, but this is flattened, right? You're seeing nowhere like the earnings drops that we tend to see during recessions. Equity markets seem to be pricing in what I would call an impossible trinity. The impossible trinity is that we're going to have lower rates, we're going to have disinflation, and earnings are going to remain resilient. Right? It's hard to see all three of those things coinciding. Right? Disinflation is hard to reconcile with good pricing power. Right? Disinflation is hard to reconcile with a near-term return to lower interest rates. It's not to say there's not a model in which this can be the outcome, but boy, it's an optimistic model. And one thing I've learned in 15 years in this business is you don't want the most optimistic scenario to be your baseline. So I'll take just a couple minutes to wrap and say, what does this mean for investor portfolios? Well, I think the most important implication is for strategic asset allocation, as it always is. Equity-dominated portfolios, so something like a 60-40, is in essence a bet on negative inflation shocks. Right? These are portfolios that tend to massively underperform in an environment when inflation is surprising to the upside. And what I think in an environment against the backdrop of high macroeconomic uncertainty, you want a portfolio that's resilient against different outcomes. Right? Commodities are something that tends to do well in a rising inflation environment. Commodities can belong in investors' strategic asset allocation. That blue bar is an equal risk-weighted portfolio, right? Risk parity, essentially, across stocks, bonds, and commodities. And you see, that type of diversification provides the most stable return across different macroeconomic environments, where a stock portfolio or bond portfolio, 60-40, which is essentially a stock portfolio, right, has very imbalanced sensitivities to different macroeconomic environments. We want to think about diversification in our strategic allocations and think about a more risk-balanced approach, or at minimum, some allocation to commodities and other diversifiers in our strategic allocations. Now let's get marginally more ambitious. Is there any way to capitalize on higher macroeconomic uncertainty? Many traditional alternative strategies are notoriously short volatility. Think carry trades across a variety of markets. So are there strategies that profit on volatility and that don't bleed on average? I can't just say go out and buy options here, because you're going to pay for that. Well, one market phenomenon that we observe that tends to be robust, that we're seeing again this year, is that it takes markets time to price in new information. Markets systematically underreact to catalysts. And this is the motivation behind trend following strategies. So trend following strategies might be one way to capitalize on higher macroeconomic volatility. We've seen in the past when we see large macroeconomic shocks, such as we saw in the lead up to the global financial crisis, such as we saw in the most recent bout of inflation, where you have inflation expectations picking up, monetary policy getting repriced. These lead to persistent market responses, right? Whether all managers know this or not, this is why trend following strategies work on average. It takes time to process new information. My firm, and something that I've worked on, is one of the kind of, let's call it, pioneers and certainly advocates of a comprehensive approach to trend following that kind of recognizes this insight that it's truly about underreaction to new information, and doesn't just look at price trends, but tries to look at trends in fundamentals, looking at trends in that new information, what we call economic trend, right? And that's something that, just like price trends, can provide reasonable performance in these types of environments. And you see, when you've had equity market drawdowns, that trend following strategies tend to do quite well. See that again here, 5 largest equity market drawdowns, and we're in one right now. And more to the point, these type of strategies love volatility. And I think that's what we want to look for in diversifiers. This is looking at the performance of these strategies and growth, inflation, and monetary policy volatility when shocks are big relative to when shocks are small, and looking at the outperformance, both economic trend, price trend, anything that is a flavor of trend following tends to do well when you see big macroeconomic shocks. Again, the most important thing that an investor should be attuned to in a high uncertainty environment is their strategic allocation. That dominates performance. It's the majority of the portfolio. But when thinking about alternatives, think about the volatility profile of alternatives. You want alternatives that ideally can capitalize on higher volatility, capitalize on higher uncertainty, not those that have more of a short volatility profile. So just wrapping up, and appreciate your time and patience. Traditional assets still face material headwinds. In my personal view, now we're a systematic manager, which makes it great because I could give my personal view and I don't have to be held to account for it in the portfolios. In my personal view, a lot of what we've seen over the past year, right, we're likely to see a continuation in the near term. Boy, right now what's going on in markets feels a lot like the summer. A lot like the summer, right? And we're likely to see continued tight policy and continued pain. But looking beyond that, likely that macro volatility remains elevated, certainly over the next few years, likely higher volatility in the coming decade than what we saw in the last decade. And against this backdrop, diversification is critical. And so I'll just end with, the maxim that gets stolen from the real estate guys: location, location, location. Diversify, diversify, diversify. That's the only solution to a highly uncertain backdrop. So I'll stop there and delighted to answer any questions.